I get tired of hearing it. I've heard it many, many times. And now I get to talk about that dry subject called public financing. So we'll start with that. Again, I'm with the Ohio Department of Development. I've been there 25 years. I've been on the finance side for the past 8 years. Before I went to this finance side, I was a business rep, but I could tell you that I never really understood the finance side. There was this group out there that was doing loans, and they didn't quite understand what they were doing. But I'm here to tell you that we can have a pretty good impact on a lot of projects throughout the state. It just so happens we're actually lending money these days, unlike some of our counterparts in the private sector. Basically, what I'm going to do is go through a really quick PowerPoint. I know you have it with you, and what I've tried to do is highlight some of those areas that you should pay attention to the most. But basically, we run 4 main loan programs, as Nate said, out of the department. And then we have a variety of sub-programs, I call it. So, for instance, we do make loans to communities. We have a rural industrial park loan program. It also has a grant component to it. And we also have the urban redevelopment loan fund. What I want to start off here is give you a little bit something I call the financing continuum. And basically, I had a lot of problems explaining where loans fit in when you're dealing with companies. And basically, what I'm showing you here is you have what they call early stage companies, what I call growth stage, and late stage. And late stage companies are typically what we call senior debt. This is traditional bond financing, it's traditional direct 166 loan program, it's traditional bank financing. These are companies that have a track record, have historical statements, and can show the ability to repay. Next thing in going back is you get into growth stage companies. These are companies that are basically taking products to market, what we call commercialization. They've already gone through the pilot stage, the proof of concept stage, etc. You get into what we call mezzanine financing, which is, again, a higher risk type financing, more based on cash flow versus assets. And this is where the Innovation Ohio Loan Fund tends to fit, a program we created about 4 years ago. Also the R&D loan fund as well. And then you get into early stage, and it's called different things, but this is where you get into the angel investors, venture capital, and folks like that. There's a variety of different grant programs that the technology division works. So once again, if anything you get out of this presentation from me today, take a look at this, because I think this really gives a nice breakout in terms of high risk, lower risk, and intermediate risk. Once again, I'm going to run through this quickly, but the direct loan program, or the 166 loan fund, our mothership as we call it, was created back in 1982. It's basically a big revolving loan fund. We loan about $40 to $50 million a year to companies. We get repaid and we lend it. It's obviously there for job creation, job retention. A couple key things. We look at projects anywhere from, for investments that we make, anywhere from $500,000. We say to $1 million, it's actually a little bit higher. We look at 30 to 50% of project allowable costs. What we try to do in our office is look at each project individually and see how we may or may not fit in. Again, real estate up to 15 years, M&A up to 10 years based on the life. A key thing I need to tell you is that with the direct loan program, with the bond fund as well, we look for a shared first position. That's really critical. We're not a subordinate lender. We want a shared first in terms of what our collateral position is. We'll do carve-outs, we'll do all kinds of things, but we want to be secure. And that is a big difference in terms of some of the other programs out there. The other key thing is we are takeout financing. In other words, you do the project, once it's complete, you write a check. We really don't have the staff to be construction financing, even though we do it on some of our bond fund deals. Traditional costs, these are fixed asset costs, land, building, M&E, things like that. We are prohibited by the state constitution from doing working capital loans, so that's why we do fixed asset. There's all kinds of ways you can look at that, but that's what we're looking at. I'll talk briefly about the Ohio Bond Fund. Michael will probably go a little further. It's basically a AA- rated fund. Basically what that means is we go to the market, we sell debt at those rates, or what the market bears, turn around and lend the money to companies, and then companies pay us and we pay bondholders. We basically are responsible for paying bondholders, and that's the key to this program and how it all works. When it's all set up, in a nutshell, it's the repayment of our direct loan fund that backs our bond program and gives that kind of rating. Again, available funding anywhere from $1.5 to $10 million. Again, the terminal loan is basically based on the life of the asset. Same type of collateral as the 166 direct loan fund. Again, I know I'm jumping through this quickly. There is a debt service reserve. 10% of the bond amount must be set aside. as a debt service reserve in terms of if things go bad, we have a little while to fix things before we liquidate. Again, eligible business costs, traditional M&E, land and building, R&D. We are prohibited by law from doing retail, and that's a key thing that I need to bring up. If you get into some of the other public programs out there, like SBA 504, 7A guarantee, they can do retail-type operations, doctor's offices, things like that. One key thing is that there is typically a prepayment penalty when you're dealing with bonds, and so you got to take that into account. In other words, we provide a fixed rate term, but if you want to prepay the bond, there could be an added cost. Again, I just threw in what the latest rates are. These are changed on a weekly basis, and then we also base the rate on when we go to market. Another fund that we created about 4.5 years ago is something called the Research and Development Investment Loan Fund. When originally created, we anticipated doing several large projects. We initially capitalized this program to the tune of $100 million, and we expected to do projects in the $15 to $25 million range, quite substantial. What we found is that, through trial and error, is that the average loan size is down to about $1.5 million. And the key to this program is it has a tax credit associated with it. And a lot of large companies like that tax credit. So I would tell you that it's had a lot more demand than I anticipated. The other key thing is that when you finance R&D, like equipment, really doesn't have a lot of value. So most companies finance it to their line of credit or cash flow. And so we're coming in there and allowing them to leverage their cash flow in order to purchase more equipment, if it may be. And so that's a really key thing. The second thing is that our definition of R&D can also be process improvement. And so process improvement can be a lot of different things. But once again, I mentioned earlier it was capitalized to the tune of $100 million, and I think we have an availability now of about 10. So it's been very popular. Again, same type of eligible costs in terms of hard assets, but once again, we're looking at things like microscopes, which traditional folks aren't going to finance. Once again, we try to take a first position or a shared first on the asset. We will consider second positions based on the project. The one I like to talk about the most here is we started this thing called Innovation Ohio Loan Fund about 4.5 years ago. And it was our attempt, the first time I've been with the department, to actually target certain industry sectors. These all fall into those sectors that the state has their strengths in. And the key thing is we're trying to provide financing to those companies that are taking product into commercialization. And by trial and error, this has turned out, I think, to be a rather successful program. We say in our guidelines that we're looking for companies that have recent history, positive cash flow, etc. That's not necessarily what we're seeing. We see a lot of companies that are losing money because a lot of times when you're in this stage, you're plowing all your funds back into R&D. So it's an expense that'll show up as a loss on your income statement. And so that's something that we have to take into consideration. What's really interesting is that the way our process works, I'm going to jump ahead a little bit, is that we actually take requests for loans and farm it out to third parties to take a look at it from a technical point of view. In other words, we want somebody else to look at it that's got some expertise in the area and say, does this make sense? From a financial point of view, we look at it ourselves because, again, we're usually the first bet in. And so it's not that difficult to structure. But once again, we're looking at the IP. Is there protection? Is there process protection? Those types of things. So we found this thing to be quite interesting. The other key thing is, I mentioned earlier that we can't do working capital, which to a certain extent, from my perspective, is good because we just don't have the staff, but because you really have to track that stuff. With the Innovation Ohio Loan Fund, if you can capitalize the cost, that means if you put it on your balance sheet, we can look at it. And as a result, we're looking at a lot of software development companies, probably 40% of our portfolio. These are folks that are developing software, and you can capitalize that cost. So in effect, what we're doing is paying for the cost of engineers and folks like that. And once again, like I said, it's very, very interesting in terms of how this program's work.